Global stocks rising, why emerging markets could be the breakout story. Global markets are shifting in a way that hasn't been seen in years. For much of the past decade, investors around the world poured their capital into the U.S., the home of mega-cap tech, stable profits, and a strong dollar. But as valuations climb to record highs and the dollar shows signs of fatigue, the tide of global capital is beginning to turn. Today, we're diving deep into why emerging markets, countries like India, Brazil, Vietnam, and Indonesia, could be the breakout story of the next investing cycle. Segment A, the data check. Let's start with what's happening right now in the numbers. Global investors have been quietly rotating capital toward Asia and other emerging markets. According to Park Avenue Securities, in just the past quarter, foreign institutional investors have poured more than $40 billion into Indian equities. The Nifty 50 and Sensex indexes have not only reached new highs, but are also outperforming major developed market benchmarks like the S&P 500 and the Euro Stoxx 50 on a year-to-date basis. India isn't alone. Across Southeast Asia, Vietnam's VN Index is up double digits this year, fueled by foreign direct investment and growing manufacturing relocation from China. Indonesia, rich in nickel and other critical minerals, is attracting capital from companies building the green energy supply chain. Meanwhile, Latin America is having its own moment. Mexico, now one of the biggest beneficiaries of nearshoring, has seen record inflows as global companies move supply chains closer to the U.S. And Brazil, long seen as volatile, is experiencing a rebound in consumer demand and corporate earnings. The MSCI Emerging Markets Index, which tracks large and mid-cap stocks across 24 developing nations, has outperformed the S&P 500 by several percentage points over the last 6 months. What's driving this shift? 2 words: relative value. U.S. stocks, particularly large-cap tech names, are trading at valuations that many analysts now call fully priced. The S&P 500 is hovering around 21 times forward earnings, while emerging markets as a group trade closer to 12 or 13 times. That's nearly a 40% discount. Add to that a weakening U.S. dollar, which historically acts as rocket fuel for emerging markets. When the dollar softens, foreign investors can buy foreign assets more cheaply, and local economies with dollar-denominated debt find it easier to service their obligations. In short, capital is on the move, and it's chasing growth where prices still make sense. Segment B, what to watch. But before everyone rushes into the next shiny opportunity, let's talk about the other side of the coin: risk. Investing in emerging markets can be rewarding, but it's also unpredictable. Currency risk is one of the biggest factors. When the U.S. dollar strengthens, it can wipe out a big chunk of gains for U.S.-based investors holding foreign assets. For example, if a stock in India rises 10% in local currency, but the rupee falls 5% against the dollar, your net gain shrinks significantly. Regulatory and political risks also play a role. Emerging economies often have less transparent governance, evolving market regulations, and unpredictable policy shifts. For instance, China's tech crackdown in 2021 reminded everyone that government intervention can dramatically reshape industries overnight. Then there's liquidity and volatility. Many emerging market stocks don't trade with the same volume as U.S. names, meaning prices can swing sharply in reaction to small events. But the flip side is that these economies are younger, faster growing, and increasingly self-sufficient. Take India. The country's domestic investor base has exploded in recent years, cushioning the market from global shocks. Retail participation is at record highs, and India's GDP growth, hovering near 7%, is among the fastest in the world. In Latin America, inflation has cooled faster than in the US or Europe, allowing central banks to cut rates earlier. That gives local companies room to borrow, invest, and expand. Meanwhile, Asia's new manufacturing hubs are not just exporting goods, they're building local tech ecosystems, digital payment platforms, and AI-driven startups. Vietnam's fintech sector, Indonesia's e-commerce boom, and Thailand's electric vehicle industry are creating new growth frontiers that didn't exist a decade ago. In short, while the risks remain, the growth stories are becoming more durable. Segment C, How to Invest, Stocks and ETFs to Watch. Let's talk strategy and tools. For investors who want diversified exposure, ETFs are the most practical entry point. A few worth watching include iShares MSCI Emerging Markets ETF, or EEM, the classic broad-based fund covering major EM economies like China, India, and Brazil. Vanguard FTSE Emerging Markets ETF, or VWO, another low-cost option with heavy weighting in Asia and Latin America. iShares MSCI India ETF, or INDA, for those who want direct exposure to the Indian equity market. Global X MSCI China Consumer Discretionary ETF, or CHIQ, a targeted play on China's post-COVID consumption rebound. VanEck Vietnam ETF, or VNM, a niche but fast-growing market attracting manufacturers and investors alike. For those comfortable picking individual names, a few stock stories stand out. In India, Reliance Industries remains a powerhouse spanning telecom, retail, and energy. HDFC Bank is one of the world's most consistently profitable financial institutions, with stable asset quality and expanding digital reach. In Latin America, Grupo Aeroportuario del Pacífico and Mexico offers a way to play the boom in tourism and trade, while Petrobras in Brazil benefits from both oil exports and currency tailwinds. And in Southeast Asia, Bank Central Asia in Indonesia is emerging as a regional financial leader, while Vingroup in Vietnam is making aggressive moves in electric vehicles and tech. For more defensive investors, consider emerging market dividend ETFs, like the iShares Emerging Markets Dividend ETF, or DYEV, which offers steady income along with exposure to long-term growth. Remember, diversification is key. No single market or company defines the emerging market universe, and a balanced mix can reduce volatility while preserving upside potential. In the end, global investing isn't about chasing the next hot country. It's about capturing the world's shifting center of gravity. And that center is slowly but surely moving east and south. Emerging markets are no longer just a small satellite in a global portfolio. They're becoming the new core of global growth. The message is clear. Valuations, demographics, and capital flows are aligning in favor of the developing world. For investors willing to look beyond Wall Street's borders, the next decade may not just bring diversification, it could bring leadership.